to another Targets in Focus interview where I'll be talking to Neal Gilbert, market strategist at GFT Markets, to talk what events have been shaking up currencies and his prediction for three currency pairs. Neal, thank you so much for joining me today. Firstly, can you talk to me a little bit about the US elections and actually how they've been affecting the dollar? Buying interest has returned to the euro dollar. How much is this due to Mitt Romney's performance against Obama supporting risk markets?
Well, I don't really think that the election, so to speak, and whether Romney or Obama are going to be elected is really affecting the euro dollar all that much at this point. Most of the movement in the euro dollar that we've been seeing lately is based on what central banks are doing. So central bank action is really having the biggest effect on the euro dollar. And last night, the debate that we did have between the two seemed to very much go in the favor of Romney, where we're actually doing a lot of analysis on that currently in order to see what kind of an effect, whether it's a Republican or a Democratic president, how much of an effect that could actually have on these currencies moving forward. But being that we're so, I wouldn't say so far away, but we're far enough away from the election at this point that I don't really think it's having too much of an effect on currencies as we move forward with them heading towards the election.
How much has sentiment on the euro been bolstered by Spain's possible request for a bailout? And with all this considered, can you give me your short, mid and long-term predictions for the euro dollar?
Absolutely. The euro dollar very much is being affected by what happens in Spain specifically. Spain, as many people are already familiar, is in a lot of trouble when it comes to their finances. Their unemployment is around 25%. Their 25 and under unemployment is around 53%. And obviously this is not a very good situation for an economy in order to be able to grow. And with the new austerity measures that are being implemented in Spain and the new issues that are arising there, especially with the potential secession of Catalonia, as well as the riots that have been going on there last week, it would seem that more pressure on the euro, or more pressure on Spain specifically, to request that bailout from the EU would really be coming into play. So for that reason, my short-term time frame, or in the short term, as far as the 1 month time frame is concerned on the euro versus the dollar, I believe that we're going to be seeing more pressure on it. And as that pressure continues to build on Spain in order to be able to request their bailout, I think the euro could decline down to about 126.50 in the near term over the next month as Spain gets more and more pressure, essentially that vice grip being tightened even further as we move forward. Eventually, I think that we're going to see Spain have to request that bailout. And despite the Prime Minister saying, no, we don't want it, we don't want those additional austerity measures coming in, giving up their sovereignty and all those different types of issues, I think they're going to be forced into it, simply because their economics and the situation that they have going there is not going to be going good for them. So I think they're going to eventually request that bailout within the next 3 months. So therefore, my 3-month target would be around 133, because if they do request that bailout, that means that somebody more financially and fiscally responsible will be in charge of Spain's finances and taking the euro up higher as people have more confidence in it. Now, as far as my 1 year prediction on this, I think it's eventually unsustainable. I don't think the euro can continue to rally with just these band-aid fixes to these major problems. Not only that, but I think Italy could be the next one on the chopping block when it comes to potential bailout situation. Now, Italy is a much larger economy than Spain, and when we get to that type of a situation, it's going to be much worse. And recently with the euro, especially over long-term time frames, looking at yearly types of patterns, you can see that the euro has been rallying on these ideas that it's fixed, and then all of a sudden it falls down even more than where it was beforehand. And I think that's probably going to happen with the euro. So my 1 year target for the euro is around 110.
This week, we've seen some disappointing data released from Australia. The country posted the largest trade deficit in 3.5 years. What was the Aussie dollar's reaction to this news, and what are your predictions for the short, mid and long term for the Aussie dollar?
The Australian dollar has been under a lot of pressure. Obviously, a lot of their economic data has not been as good as it was hoped to be. And in fact, months ago, the RBA, the Reserve Bank of Australia, was cutting interest rates, but then they started raising interest rates again as things started to improve. But then recently, just this past week here, we have seen the RBA again cut interest rates. Now they're a very proactive Reserve Bank, so they tend to get out of ahead of problems relatively quickly. And with that, that kind of brings the fear that perhaps things aren't going around the rest of the world as good as we might have hoped. And so, therefore, with the cutting of those interest rates, we have seen a pullback in the Australian dollar. We also saw hints from the RBA that they could potentially cut interest rates in the future as well. So that means that we could potentially see some more downward pressure on the Australian dollar. And as a matter of fact, my 1 month target for the Australian dollar is right around parity. So parity would be the level I think we're going to get to. And I think we might even run a little bit beyond it. However, after that, I think we could see from China some more stimulus measures. China is very proactive when it comes to how they handle their specific situations and how their economy is running along. China really has been the engine of the economic system here for the last few years. And that being said, I think they could potentially increase more stimulus or provide more stimulus and start building some more things and really start going down that road to where they're needing more raw materials from Australia. And that spells good things for Australia if that is the case. And I think the 3-month target here for the Australian dollar could be around 108 as we start to see a very large jump in demand for those raw materials from Australia. Now, also, Australia is sensitive to the global economic total atmosphere. And my prediction for the euro was that it's going to eventually start falling down towards 110. I think that downward pressure will probably also weigh on the Australian dollar as the global economy just isn't all that healthy, and we start to see it fall back down under that parity level down to around 96 at my 12-month target.
Euro-Japanese yen has been climbing higher towards the end of this week. How much has this got to do with both oil prices and the Bank of Japan's rate decision? And can I ask for your predictions for the dollar-Japanese yen?
Absolutely. The dollar-yen has been heading in an upward direction as of late. It's more of just a gradual rise that we've been seeing. It hasn't been anything really all that significant. Recently, Japan has just replaced their finance minister, and the last time that they replaced their finance minister, it took them about a month, or actually about 45 days before we actually saw some intervention from the Bank of Japan. Now, if they follow the same type of policy, then we could see maybe in 1 month some intervention from Japan. However, I think that the dollar-yen needs to fall down even further before we start to see that type of intervention play. Right around 75.50, 76, somewhere around there, I think is really the levels that we could see intervention for the Bank of Japan. And their most recent stimulus efforts in that they're trying to increase their asset purchase program to try to essentially tell people, hey, holding Japanese yen is not a good idea, hasn't worked exactly the way that they had envisioned. As a matter of fact, the Japanese yen actually gained in value after that. So I think we're probably going to continue seeing that type of action. And really probably the most exciting part of the Japanese yen is if and when that intervention does occur. And again, I think it's probably going to be down a little bit further. So my 1 month target for the Japanese yen is down around 77 as we see that continued drop in the U.S. dollar, especially with the Federal Reserve here in the United States being the most influential central bank in the world, continuing their Fed QE to infinity and beyond. We're going to continue to see dollar weakness, which means that the dollar yen will continue to fall. 77 as far as my 1 month target. I think it's going to fall even beyond that, down to around 76 at the 3 month target. And then once we start to see it at that 76 level, intervention really becomes a factor. And once we start to see that, I think that we could see some intervention coming into play, the dollar yen starting to head in an upward direction over an extended period of time, and really people starting to realize that Japan's economy is not healthy at all. Now, many people already are familiar with this. You know, they have 200% debt to GDP ratios. They have an aging population. They have a variety of different issues that are coming into play here, and I think that will start to weigh down more on the yen as we move forward into the future. So therefore, my 1 year target on that is around 90, and for it to return back up to those levels.
Thank you, Mr. Gilbert, for your insights and predictions. That's all from me, but join us again Monday for the latest economic news and data releases. Have a great weekend.